Hello and welcome everyone to another weekly market commentary and general updates from myself and our Chief Investment Officer, Freddy Lim.
Hello.
Hey Freddy, good to have you back. It's another exciting week that has started already. So lots of news items that we want to cover today that you might have heard about over the last 24, 48 hours. As well as another topic that we always get questions on at the end. Before we get started, there's a couple of great events coming up, one in Singapore, one in Malaysia. They're both going to be on the 2nd of October next week. That's the Wednesday. And the first one is in Singapore. We are actually getting together with Nikko Asset Management and Lion Global, people that Freddy works quite close together with. And we're going to talk about income portfolios. That's on the 2nd of October, so if you want to sign up for this, you can see the link on this slide that is showing right now. And then in Malaysia, same day, we have a seminar on how to plan for your retirement. Again, there's a link here that you can sign up on. You can also find these events on our website, on Eventbrite, Facebook, wherever you are connected to us. So up to you, but there's otherwise also the support hotline that you can reach out as well. With the events covered, Freddy, let's talk about economic events, or let's start actually with the Ukraine situation that Donald Trump is in, or finds himself in right now. And I know a lot of people are probably already sick of hearing impeachment because it never really happens. He can kind of do whatever he wants. But what is even going on? And maybe you can put this a little bit in perspective.
Well, there's this thing about Trump's potentially and blatantly disregarded the protocol, and in foreign relations, when he spoke with the Ukrainian leader, he mentioned about having them investigate more into Joe Biden and Biden's son, who actually have businesses in Ukraine, I think gas and oil projects and all. But then it's really, it could be taken in any way. It could be in passing, it could be a conversation. Nobody knew exactly what it is. It could be Trump could actually, as part of the broader discussion about Europe, he actually mentioned Europe is one of the reasons why Trump held back aid to Ukraine, right? But this came out as part of that conversation, and there was a whistleblower in the administration who sort of exposed that fact. So now it's become another political circus where the Democrats are now more emboldened to try to step closer to impeachment.
Yes.
Right? It's an inquiry, it's not really an official act of impeaching, or it's just an investigative series of circuits. Yes. Right? That's already ongoing for a while on Trump. It's been ongoing. So that is what's been going on. But on your point that Trump is virtually impeachable, that's also quite true in the sense that unless the Republicans in the Senate had a lot of backbone to actually not defend the president.
And even the Democrats, it's not in their interest right now either, right? Because what's the solution that they have afterwards, right?
Yes.
They still need to get the votes, right?
Yes. And in the end, maybe the Democrats just got baited into the 2020 general election and made it all about Trump again. He wins all the topics, and he's unimpeachable if one of the one of the chambers of the Congress do not go ahead. So this could be just another political brilliance that goes on with Trump.
Exactly. Oh yeah. So, but again, we just want to cover it, right? Because it's been obviously the news overnight quite a bit.
Yes, it would have some volatility on markets because people are actually afraid that, given how Democratic candidates are now positioning their plans, not so market friendly, right? Wealth taxes, break up big firms, and
lots of
uncertainties. People still prefer, the markets probably still prefer Trump over an uncertain.
They know what they have, right, with him.
Yeah.
By now they kind of know what he says is usually what's happening, right?
Yes.
Good. So next topic. Last week we talked a little bit about it, but there's some developments on the trade talks as well. Anything market related that might make sense to mention, or
it's been overshadowed by the whole impeachment inquiries, but what has been subtle improvement has been, for example, China announced that they're going to give more exemptions to firms in China to import soybean.
Yep.
And also today, I think it's today or yesterday night, they came out and also openly expressed that they would ramp up the purchases of US pork.
Yeah.
Right? So there are very subtle gestures that's been going on the trade talks and that people are just ignoring right now. So just keep in mind that things are thawing a little.
Yeah. Yeah, and some meetings are set up for the next few weeks anyways, right? So let's see what comes out of that. Good. And then for investors, for us, we follow economic models, right? Maybe a little update on where does the economy stand right now. I think we haven't touched on that too much lately, but maybe we can give an update.
As you knew, in mid-August, StashAway reoptimizes tens of thousands of portfolios on the platform, and we went over the strategy for non-US global economies.
Yeah.
And now that's unchanged. The uncertainty is still high, but things seems to have been bottomed and just stay around there. So it's not getting worse, but it's not getting better. So only time will tell. But in terms of the US, the lagging indicators such as industrial productions have shown that the rate of change has really started to come down. So in the beginning of the year, we have about 3.6 percentage point of annual rate of growth in industrial production for US. It's around close to 0.4% last month. So people may get a bit afraid of that, but the truth is that the leading indicators are the better ones to look at. And if you look at the conference board leading indices, they have remained fairly steady at around plus 1.6% year-on-year change for the last couple of months. They haven't really further worsened. Yeah. They've been staying there. So in a way, no cause for alarm, but it does caution us to not overreact to news or even any short-term indicators, but just stick to your long-term plan and diversify, balance out your risk, continue to do all that, and things don't change.
Yeah. No, I think that sums up on the economic side. So finally then, let's talk about a question or like a statement that we often get, right? And that is, should you as an investor expect average market returns? Because a lot of people say, hey, you can on average expect 7%. So people in their minds think that that's what they get every year, right? But that's not how it works.
Well, there's two points to make on that. The first one, let's tackle the obvious. Do you think every year you're gonna get the average return? No. Some years you get above average, and some years you're gonna get below averages.
Yeah.
Right. So in the sense that to get the average, it assumes that you're not taken out by the markets, that you're able to set the right risk and stay invested in the markets.
Yeah.
If you are out of the market and the market flip back up, you're out.
Yeah.
Stone cold. The averages has nothing to do with you.
Right.
You're out of the family of averages, right? To be realizing the averages requires time to compound, time in markets. So again, it's about sticking back to your investment plan.
Yes.
If you're worried about your risk, you're not sleeping well, review your risk level.
And that's why it's very important to, if you set up a one-time financial plan and you use an expected rate of return, right?
Yes.
If you use that, it will only be there if you stay long enough, right? If you use 7 or whatever percent that you try to obtain,
yes.
Right? You're not going to get it by getting in and out.
Yes.
So
it assumes that you're reinvested, right?
Yes.
Yes, and you compound.
Yeah.
So that's the first point. The final point would be that averages are not exactly averages. For example, S&P 500 is the top 500 companies in the US by market cap, and it means that, don't forget, we have a lot of disruptions these days. Companies spend less time, staying in the index now. They get disrupted faster, they get competed away. So you're actually not just getting the averages, you're getting the fittest 500 companies, for example, in this case. And so it's not quite mediocre, it's not quite average, it's actually a survival thing. Now, why am I saying this? Because if you're investing in very concentrated manner, you buy a particular name, right? For example, Thomas Cook,
yes.
This came out right, with a lot of trouble. Boeing a couple of months ago with the airplane incidents, and that affected the stock prices. So when you are investing in single names, very specific area, you are very concentrated. You're taking on a lot of risk. It's not just a systemic risk that you're taking to the general market. You're taking a lot of random, idiosyncratic risk to the particular investments. So you may not be getting the average if the company that you own goes completely bankrupt and the recovery value is zero permanently.
Yeah.
That's done. So in a way, it's sort of the average debate. tells you that you want to stay diversified as well.
Yeah.
Yeah.
Well, thanks, Freddy. For everyone else, if you have any questions or you want your question answered here on our weekly commentary, please feel free to put them down below the video so that we can pick them up for one of the next few weeks to answer them. Otherwise, I wish you all a good rest of the week, and we'll be with you next week. Ciao.
Ciao.